Good afternoon. My name is Seth Chavez. I'm the executive director of the San Fernando Valley Bar Association. Today we have David Scheidemantle as our presenter. He's president and managing partner of Scheidemantle Law Group, PC. He's represented policyholders in disputes with insurance companies for 35 years. His coverage practice spans numerous types of insurance coverage from large property losses, environmental claims, wrongful death, toxic injuries, cyber coverage, and professional liability, directors and officers, products liability, construction defects, and builders risk. He loves the highly technical, cerebral, and creative aspects of coverage practice, as well as fighting for the underdog and underserved in bad faith litigation. With that, thank you for being here, and I'll just pass it over to David.
Thank you very much, Seth. Did you happen to get the PowerPoint?
I have not.
But something is on the screen. I wonder if yours is working, David.
No, that's just I was able to get a background up so people would not have to look at a light.
Ah,
But that's interesting that that has not shown up yet. But I'm just going to get started, and I will talk without. I'll talk from my PowerPoint without it until it shows up there, Seth. So the
Very good.
subject matter of this talk is avoiding insurance traps, pitfalls, and swindles for the real estate professional and those who represent them. And I got this notion of traps, pitfalls, and swindles from a book that I loved when I was a teenager, and it was about playing chess, and it was called Chess Traps, Pitfalls, and Swindles: How to Set Them and How to Avoid Them. And my experience in the insurance industry representing policyholders is that most policyholders are very unaware that these traps, pitfalls, and swindles are being set for them. And as I like to say, insurance is never a problem until you have a claim, because too many folks get their policies, put it in an actual or a virtual drawer, and just assume, well, I've got insurance. When in fact, when the chips fall and things are not going well, the insurance company might very well take a different position. And the example that I thought we could start out with is not from a property loss; it's a liability loss. But I think it's an 11th Circuit case where a dive master, someone who ran a diving company, actually had a death and had a wrongful death suit against him for an accident that occurred while he was performing his trade as a dive master. And he didn't know that the policy excluded bodily injury, loss of life, or illness of any person while in the water, or arising as a consequence of being in the water. Now, clearly, the dive master had no clue that his policy said that when he bought it. And very equally clearly is that his broker never took the trouble to look and to tell him that. But these are the sorts of traps, pitfalls, and swindles that I see every single day. And it's something that people need to be aware of if we are functioning in the world of the law and in the world of risk representing clients, because we need to help our clients prepare themselves to deal with these sorts of risk. So if you had the PowerPoint, we had some very fun slides here about anatomy, and we were going to talk about, and I will address the anatomy of an insurance policy, because very often I used to say, somewhat tongue-in-cheek, but it's actually not too far from the truth, that one of the challenges to being an insurance coverage lawyer is to actually get a hold of the policy. Back in the pre-digital age, when I would ask for the policy, I would often get something that had pages 1, 3, 5, 7, 9, etc., but would miss the even pages because the assistant in the copy room had not actually realized that it was a double-sided document. But now the problems are equally daunting, and that is we very often see we'll ask for a policy and we get a certificate of insurance. And a certificate of insurance is hardly the policy and has some very problematic aspects to it, which we'll get to later. And the practice of many insurance companies these days is to issue their policy. So you get a policy in 2025, and then you get to 2027 and you've received some stuff in the mail, and someone says, well, let me see your policy. And what you end up providing is the renewal packet. It just has some endorsements and such, but not the actual root policy. So if you want to skip ahead here to the page that has the skeleton on it, we skipped the football analogy. That was the chess analogy. And here we are with the dive master. And whether you are an emperor, dive master, or in business, don't get caught without your clothes was the problem with that case. So scroll down one more and you'll get to the skeleton. There we are. We're going to talk about the anatomy of an insurance policy. So the very first thing you'll see in the actual policy once you have it, and let me digress for a moment. We talked about getting these renewal packets. My recommendation to every client and every lawyer who has clients who have insurance policies is never, ever to throw away your policy. Even if you think it's expired and long over, keep your policy. There are lots of reasons for why it might become relevant later. And in this particular instance, what you think you're throwing out the policy, and later on you get what you think is a new policy, but it's really only a renewal packet, and you have to, for the real terms, you have to go see the original policy. So the declarations page of a policy is a very important thing, and usually there's a declarations page in both the original policy and in the renewal packets, but it identifies all of the things that are included here on this slide. And some of it is extremely important that people don't even think about. Like the very first one, who is the named insured? I can't tell you how many litigations I've had, and I actually have a $5 million case going on right now about who's insured under the policy. People don't, not all brokers pay attention to this, and not all policyholders do either. And for example, in the real estate field, suppose you represent a landlord who has 100 properties. Who's the named insured? Is it only the landlord? Well, suppose the landlord owns those policies through a separate purpose entity, an LLC. That's what my case is about right now. It didn't name the LLC specifically in the policy. So the insurance company is fighting back about that. Now, you'd think in the practical world, the insurance company is going to realize, well, obviously, the LLC has to be an insured if you're insuring the property, but that's not the position the insurance company is taking. And that's a typical example of a trap, pitfall, or swindle to be avoided. What properties are covered? I've had cases where there are 1,000 properties and the one in question is not in there for some reason. And that's become a problem with the case. What are the forms included in the policy? There's usually a list of forms, and very few people will actually take the trouble, but if you compare the list of forms with what actually forms are provided, you're going to find that there are mistakes. There are forms that are missing, that are identified, and there are forms that are in the policy that are not identified on the declarations. Again, one of those probably more of an accident than anything else, but something to be aware of. What's the policy period? Who's the insurer? If I have a problem, is it Chubb or is it Federal Insurance Company, one of its subsidiaries? That's gotten some of my clients into trouble. And it very often identifies who you should contact if you have a claim. Let's proceed to the next slide. And this, we're going past, that's what we just talked about. And then if you go to the next one, we have the other parts of a policy. Let's go back to that one with the insuring the fish. We're looking for that fish. There we are. The insuring agreement is the part that says we will cover you for this. That's one of the most important part of the policy. You look for definitions. One very common trick is for the policy to have, say, that capitalized terms are defined, and then there's a capitalized term, but it's never defined. That often happens, and that provides us policyholder coverage lawyers with some fodder for arguments about whether the policy is vague and ambiguous. There are exclusions, and as a subset to that, there are very important exceptions to exclusions. And there are the conditions that must be followed, the endorsements, which are sort of like the amendments, and then schedules, which often list things like identity of property insured. I have seen a number of policies that say that the policy covers the property, whether it be personal or real property, on the schedule attached, and there's no schedule attached. So when you get your policy or you get your client's policy, look to see, is the schedule attached? Because you don't want your client paying for millions and millions of dollars in scheduled properties for premiums, only to find out that there's a much lower cap for a blanket endorsement, and there's simply very little coverage under the policy. I've seen that happen all too many times. So you can skip the next slide or just show it briefly with the picture of the animal being examined there, because we talked about certificates of insurances and renewal packages and the differences between those. So let's go on to the next slide, which talks about some of the different types of policies that you're going to see as a real estate lawyer. There's the commercial property insurance, which has various aspects to it, or could be purchased as a separate property, but something you may be aware of or interested in pursuing if your client is interested in extending its coverage to these sorts of topics. Very often there's going to be a loss of business income, also known as business interruption aspect of the policy. You're going to want to look at the policy and see how long does that last. Suppose that beautiful building in the graphic there were to burn down, and suppose there was only 12 months of loss of business income. That would mean you'd need to get that building rebuilt in 12 months, which is not going to happen. You're going to barely get the insurance company's attention in 3 months, and then there'll be a fight back and forth about how much it's going to cost, and you'll be lucky to get that building up in 3 years. And meanwhile, you only have 12 months of coverage for loss of business interruption. If you have income, if that's a rental property or whatever's happening on that property. So take a look. Very often you have other options. You could get a 24-month option or a 36-month option for not that much additional premium, but you can't do it if you don't know about it. And they're more interested in shrinking the period of loss of business income, they being the insurance company, than they are in making sure that your client is adequately protected. If your client is in a zone where there might be floods, you might inquire about how much it might cost to get flood insurance, other types of natural disaster insurance, and of course, earthquake insurance, which usually has two aspects to it that are unfavorable but unavoidable. One is an enormous deductible, and two is a very high premium. For clients who lease properties or rent them out, there's the rent guarantee insurance. Not everybody knows about rent guarantee insurance, but it provides insurance if the tenant doesn't pay over a certain period of time. If you're renting a property, you should have rental insurance to cover the contents. Homeowners, obviously, CGL, that's just to protect the liabilities of the business. Builder's risk insurance. Some clients will think, well, I have a property policy, but I'm going to rebuild some things. I don't need a builder's risk policy. But they work differently. And if there is going to be construction, that you should look into having a builder's risk policy. And you should look into whether that policy will be owner controlled, OCP, owner controlled policy, or a CCP, a contractor controlled policy. For the property owner, it's better for it to be an owner controlled policy. Cyber risk, no one should be without cyber policy these days, because trying to fit a cyber loss into a CGL or a property policy is like a square peg and round hole. Errors and omissions, depending on the business of your client, everybody has to have workers' comp. Some people skip the employer's liability insurance, which is not something I recommend if you have employees. You never know what's going to happen. And last, I have their cannabis insurance. Suppose you're a commercial property and you lease the property. to businesses, and one of them happens to be a cannabis-oriented business, very often these policies will contain a cannabis exclusion if you don't purchase the additional rider for cannabis insurance. Let's go on to the next slide, but maybe I'll just pause it there and say, does anybody have any questions so far? Hearing none, I will proceed. No, I love this graphic. I didn't make it up, but it's actually the way I feel, and at least one court has said about certificates of insurance. I find in the world of real estate, people rely on certificates of insurance as if they're very valuable documents. Uh, at most, they provide evidence of the insurance, and they should be kept for that reason alone. And at most, they provide the certificate holder with supposed, and I'll follow up on that in a minute, proof that the policy existed as of the time that the certificate was issued. I am aware of a situation in which a client had the software and they would just print these things out willy-nilly without actually making sure they had the required coverage. It's obviously a form of fraud, but don't assume that just because you have a certificate of insurance that there is actual insurance. Many times people will think, well, I have a contract with a so-and-so, and so-and-so has agreed to make me an additional insured on the policy, and I look at the certificate of insurance, and sure thing, it says that I'm an additional insured. That's all good. I'm covered. Not so fast, because the form itself, if you look at and I would say fine print, but it's not even fine. It's actually bold. It says this certificate does not confer additional insured status unless the policy provides for additional insured status for the additional insured. So what you want to do is you want to look at the policy. Does it have a blanket additional insured endorsement? And if it does, have you followed what's required in order to trigger the coverage? For example, some additional insured endorsements will say, if you are obliged by contract to make someone an additional insured, then they will be under this policy. Not everyone checks to make sure that that is actually the case under the contract. And I've seen situations where, for say, there's a duty to indemnify, but not a duty to make someone an additional insured. The same thing is true with the waiver of subrogation. For anyone who's not familiar with the concept of subrogation, suppose that you are a tenant and you and the landlord have agreed that the landlord will waive subrogation, being that if you cause a loss and the landlord's insurance company pays, under the law, the landlord can proceed against you, the tenant, to recover that loss. That's called subrogation. They stand in the shoes of the landlord. But if you have a waiver of that, then you can avoid that. So if again, a contract might require a waiver of subrogation, but it actually has to be in the policy and not merely in a certificate of insurance. And the quote there from the Bradley real estate case is, in effect, the certificate is a worthless document. I wouldn't quite go that far, because it does provide evidence that there was insurance, which can prove to be useful in terms of locating the insurance company. But and I believe that was the case where the lender was supposed to be named as an additional insured, and the certificate said they were, but in fact they weren't, and there was no coverage. So even sophisticated lenders can get caught up in this quagmire, or caught within these traps, pitfalls, and swindles that if you can find yourself if you don't protect yourself. So let's go on to the next slide, which I think is another picture of the shredder, which summarizes the advice that I came out of there, and that's require the additional insured endorsement in the policy. Make sure there's contractual indemnification if that's what's required by the endorsement. And the certificate is not a waiver for subrogation waiver. The policy, the certificate is not a replacement for a subrogation waiver. So I worked on a project once in Pennsylvania where the client was rebuilding or building a water line to deal with a pollution issue. And it was about a $40 million project. And we told the environmental lawyer on our side, we want to see all the insurance policies. And he laughed at us. He says, nobody does that. I said, well, we're going to do that because that's what we need to do in order to make sure the client's protected. But that is the attitude of the industry very often is, oh, well, we don't need to jump through all these hoops. It's just not necessary. No one does it. They'll be mad at us and they will laugh at us. Well, it's better to get laughed at now than to cry later. So let's go on to the next slide. Okay, so I mentioned that it was important to keep your policies, and that's because you want to know how your coverage looked like from the inception of the program, of the insurance program. And the most important aspect of this is that there could be an exclusion that crept into the policy later that the insurance company is now relying on to deny coverage. And what you want to know is, well, when was that exclusion already there? And if it wasn't, was it introduced in a manner, and this is magic language under California case law, conspicuous, plain, and clear. Now let's go to the next slide. And this was actually a deposition of having to do with a lead paint problem. And a landlord had a tenant who sued for lead paint exposure. It was a high dollar numbers in terms of claim damages. And when the policy was first issued, it did not have a lead paint exclusion. Later on, it got introduced in a very obtuse way. And so our position was that even though there was a lead paint exclusion within the guise of a noxious substances exclusion, that it was not conspicuous, plain, and clear, and therefore did not bind the policyholder. We actually ended up getting more than policy limits to cover that claim, even though there was supposedly a spot-on exclusion that would have barred the claim. And this was an actual transcript of a deposition where the insurance company executive is saying that they can't find the lead paint exclusion anywhere in the policy. And we did this over and over again with numerous insurance company representatives, and we'd make them squirm for an hour looking at the policy, trying to find it, and none of them did. Let's move on to the next slide. All right, vacancies are very important. Whatever policy you have that's a property policy, you want to look at it and see whether it has any detrimental aspect to the property being vacant, and what does vacant mean. Very often a policy can exclude damage if there's vacancy. And in this instance you're looking at here, there's a reduction in coverage if the property is vacant. So you want to be aware of what vacancy means under your policy. Avoid a vacancy if you can. Other concepts are to change the way vacancy is treated under the policy or defined. There was a recent case in this area where vacancy was defined to be the property owner not utilizing the property in the ordinary fashion of its business. And it was a landlord. And the property actually had no tenant, but the landlord was actively trying to rent the property. And the insurance company said, well, it was vacant because you are in the business of leasing properties, and this property was not leased. Thankfully, the court disagreed with that and said, well, they're in the business of leasing properties. That doesn't mean they're always occupied by a tenant, and therefore the vacancy provision does not apply. And there's coverage. But that's the kind of thing that you deal with in the world of vacancies. So see what your policy says about vacancy, make sure your client knows about it, and can take steps. There may be enhanced protective safeguards during a vacancy that you might want to take into account. For example, there may be certain security requirements or whatnot, or inspection requirements. You want to make sure you're following those. Let's move on to the next slide. All right. So we talked a little bit earlier about contracts that you have, that your clients have with other parties who are involved in its business. And first of all, if you are imposing insurance requirements, you want to get good at knowing what those insurance requirements should be. And you want to make sure they're clearly spelled out in the contract. And then you want to make sure they're actually followed because I can't tell you how many times I've seen a situation where there are very nice insurance requirements in the contract, but the parties stuck the contract in the drawer and they didn't actually look at them and follow them and to make sure that the protections, the insurance protections in the policy were actually followed, that the insurance was in place. Um, and etc. So I see a note from Marshall there. I've had problems in getting insurance for properties that have, I didn't finish reading it, Matt. Marshall, can you get on, just tell us what your question is?
I've had problems in the past with getting insurance for properties that have like three or four different trusts that are owners. The insurance companies don't want to insure trusts with multiple owners. Have you encountered that problem? And if you have, any suggestions for obtaining insurance?
Yeah, I mean, I have encountered that problem, and it's usually done on the broker side. And I suggest that the best suggestion I can have is to work with a broker who has relationships with insurers, it may be out of jurisdiction, non-admitted, so-called a non-admitted carrier who would be more likely to do that, like a London carrier. But it's clearly a broker issue and it's a timing issue. If you need to do it quickly, you need to start early in order to find an insurance company that will do it. If there's another way to structure the ownership of the property, that may be a way around it, but you wouldn't necessarily know that until you were dealing with the underwriters in question and what their concern was and how to address it. So let's move on to the next slide. Okay, I thought it would be useful to go through a few real world examples for how policyholders have gotten the short end of the stick without knowing before they had a claim that they actually had a problem. But I did have a client that was a recording studio and they had an exclusion for the work of a recording studio. So something nasty was going on with that policy. But it should not have been discovered after there was a claim. It should have been discovered before there was a claim. In that read it and hey, wait a minute moment where you realize there's a problem. There's a famous restaurant chain that had a cyber policy and it had an exclusion for credit card transactions, which makes no sense in like the business of a restaurant chain. But whichever circuit, it wasn't my case, thankfully, but it was a circuit court that said, well, if they were smart enough to get the policy, they should have been smart enough to read it and to know that they had that issue. I would say that cyber policies in particular are hotbeds for problems. Cyber policies have been around since the 1970s, but unlike most policies, there's no standardization. You're dealing with manuscript policies from whomever you're getting them, and they're all different. So you want to read them and you want to understand them, and you want to figure out whether there's an alternative, either with a different carrier or with purchasing an endorsement that will undo some of the negative aspects. What these policies do, if you're not careful, is they find out what are the most prevalent schemes that are in the cyber risk area, and then they built in exclusions for those schemes. So if you get this, if the secretary receives the email supposedly from the CEO and it says, please wire $10 million to this account, and the secretary goes ahead and does that, I would say there are fewer than half of the cyber policies that will address that risk because they don't call it that the fraudulent communication was not fraudulent by the secretary. So you want to watch out for those sorts of details. We talked about the property policy that didn't list the property. And I love this one. There was a real estate brokerage, and they stored all of their information in the cloud, and it was compromised. And they had a cyber policy that had an exclusion for all information stored in the cloud. Now, in this day and age, is there any information that's not? So that's the kind of chicanery, I will even go so far as to say, that you need to be aware of, and it could happen to you. Can you move on to the next slide, please? We talked about the issue of the schedule. A client of mine had a jewelry policy. Thankfully, it was pre-claim, and he asked me to take a look at the policy, and it said that there was a $3 or $4 million limit for scheduled jewelry and a $100,000 limit for unscheduled jewelry, which is designed to protect the policyholder if they happen to buy some jewelry during the policy period, but it hasn't yet made it to the schedule. But the schedule was entirely missing. I'm seeing a question there from Mark. Hey, Mark, if this is the Mark Carlson that I know, hello, and how are you?
David, how are you? I saw
Good.
your thing and I couldn't miss it, obviously.
Well, we'll be giving autographs later, so if you're
All right.
interested. Did you have a question?
So I just on the cyber policy, you touched on it, but I see a lot in my practice of defending real estate brokers where they'll buy a policy of cyber insurance and it'll have $1 million, $2 million limit. But if you look at what that covers, it's only the notification and credit monitoring requirements that may happen when you have a breach of your data systems. But then for wire fraud or cyber theft, there's a sublimit that's usually very low, like $50,000. So people think that they're well insured for things that you mentioned, where the secretary sends an errant wire to Nigeria, but they're really not.
No, that's a great point, and congratulations to you for actually looking at the policy. It's not in this presentation, but should be, that sublimits are very important to look at. The sublimits you mentioned there, for example, if you're in your own homeowner's policy, you could have $1 million coverage for personal property, but there could be a sublimit of $10,000 for jewelry or art or something like that. And if you're not aware of that, it could come as a shock later. So you want to be aware of it and see maybe if you can up those sublimits. When you're buying the policy, that's the time to do it, because increases in the sublimits are not likely to have a substantial impact on the premium. There's one there to watch out for, the second large bullet there. Real estate broker or estate planning lawyer didn't counsel a homeowner. They transferred the home to a trust. People create these trusts that's going to hold their home, but they don't ever change the policy. They change the title, but they don't change the policy, and that can cause a loss of coverage. If anyone has that problem, call me, because we've seen insurance companies take that position with these so-called family trusts, which are revocable trusts. And our position with respect to revocable trusts is that they are really not a genuine entity for purposes of insurance, that it's really still the creator of the trust, the settler of the trust, who is the insured. And there is some case law in that. So it's good to be aware whether it is a revocable or an irrevocable trust for purposes of coverage. But regardless, if the property is transferred to a trust, get that trust on there, not exclusively, but at least as an insured or an additional insured in addition to the settler. Let's move on. Okay, protective safeguards. That's not too visible on that screen, so I apologize. But protective safeguards in the example on the screen is in the context of a builder's risk policy. And the builder's risk policy says, well, we're covering you for $1 gazillion, but you need to do these things. You need to have hourly security rounds during non-working hours. You need to have certain lighting around. You need to have clearance of brush around the perimeter of the property. You need to have certain sprinklers at certain points in the construction, and that sort of thing. Well, I had a large claim, and the policyholder and the contractor had followed none of those things. And as a result, a 17-year-old arsonist had snuck into the property and burned it down during the construction, and the insurance company was about to deny coverage. The only way we rescued it was by taking over the cell phones of all of the security guards to cobble out a log showing that they had generally been following the hourly rounds requirement, even though it was never booked in a log and they were supposed to have a log. So we created a log and we backed it up with information, GPS data and other data from cell phones. Now, the fact is that we had no data showing that they had done a round at the time the 17-year-old had snuck into the property. So the insurance company still agreed with us that there had been substantial compliance. But you want to know, it's certainly in the builder's risk context, you want to know what are the protective safeguards and are they being followed? Now, protective safeguards are not exclusively in builder's risk policies. They're in all sorts of policies. They could, for example, be in an art policy or a jewelry policy. An example in a jewelry policy would be that the item needed to be in a safe and could only be taken out 10 times a year. So let's suppose the jewelry is stolen. The typical thing that would happen is the insurance company wants to offer sympathy to the poor person who lost the jewelry. They call that person up and they say, "Oh, I bet this was a really valuable piece for you." And she says, "Yes, this was my grandmother's. I can't believe it's gone." And he said, "I bet you wore that all the time, didn't you?" And she said, "Oh, I wore it every day." Done. No coverage. She was tricked into admitting that she did not follow the protective safeguard in the policy of removing it only 10 times a year. I had a coverage matter for a owner of a $15 million violin, and his policy said that the instrument was covered only while it was in his own home, even though his standard practice was to lend it around to great performing artists throughout Los Angeles and in some respects the world. So as lawyers, we have to be aware of protective safeguards, but they're not really called that in the policy. Where they hide is in the application for the policy. So in your application for your malpractice policy, it's going to say, do you do this, that, and the other thing? And you want the policy, and your assistant who's filling it out just checks the box and says, yes, we do. We perform conflict waivers on every matter. We have a dual calendar system to make sure we don't miss any deadlines. Whenever we reject a client, we always send a letter of non-representation. When a matter concludes, we always conclude it with a letter that says the matter is concluded. And says, do you always do these things? Yep. But in fact, you don't. Claim based on something that might have happened in connection with one of those things, claim will be denied because those function as protective safeguards in the application for the policy. So in cyber policies are huge. The same thing, it's in the application. Cyber policies can have like a 25-page application where you have to say all the things that you do to guard against a cyber attack. And people too willingly think that they just need to get the coverage and they want it to be cheap. So they fill it out and it's not correct and the coverage will be denied as a result. So it might have been cheaper, but they were paying for nothing. So we're going to skip through the next pretty floral pictures. I think we're getting pretty close to the end here. These are just examples of protective safeguards. On the PowerPoint itself, these actually look legible, but on the PDF, for some reason, they are not so much. So let's see.
You have 15 minutes, so I think you're good on time.
Well, we can engage in a discussion of questions, or let's just get to the end and see if there's any other points I wanted to make that are included on this one. So let's pass the flowers. Yeah, so often, very often when clients call, they want to say, let me know if there's coverage. I often get, well, before I hire you, is there coverage? And that's a little bit like going to the doctor and saying, before I hire you to treat my disease, will you tell me if you can cure me? And oftentimes the doctor won't know because they haven't conducted tests. They don't know really what's wrong with you. And they don't know necessarily the course of treatment or how you will react to the course of treatment, all of which are analogous to various aspects of litigation, but I would say insurance coverage in particular. So usually the question of whether there is coverage is nuanced and gray because for two reasons. Number one, insurance companies purposely design policies to be gray because they want it to be good enough to sell, but not necessarily good enough to pay claims. So they want to fit into that gray zone. That's the nefarious aspect of it. But just the non-nefarious aspect of it is you're dealing with language on a page and then you're coming up with some situation that you can't predict every single situation and they're all different. So does the contract fit this situation? And I have a case right now that is spot on in that within that context because there was a pollution event that was caused by a combustion event, and the insurance company and the combustion event itself was precipitated by an alleged failure of an old piece of equipment. And so there are numerous exclusions at play, including the wear and tear exclusion. But the wear and tear exclusion has an exception, and the exception says, well, if it results in a specified peril, and in our case would be a fire, uh, then there's coverage. But the insurance company is disputing whether there was a fire, even though there was smoke, sparks, and combustion. So that's all nuanced and gray because it's all about the facts and what actually happened. And just to digress a little bit into insurance nerdness, that dispute will turn on who has the burden of proof that it resulted from a specified peril. So this is a highly technical area. Why don't you go on to the next slide? Yeah, so that I'm big on prevention and cure. And prevention and cure is very few clients will want to pay for prevention. They think their broker is handling the review of the policy, so they don't want a lawyer to do it. And oftentimes that makes sense, but someone ought to look at it. And the more effort when it comes to insurance that one can devote to prevention, the less likely that there'll be a lot of money that has to be spent on the cure. And it's the same thing with with the application. A lot of the things we talked about. Are people paying attention to the application? Are people paying attention to the protective safeguards? All these things fall into the category of prevention because they all take place before there is an actual claim. My entire world of being a coverage lawyer in the context of disputes is when those things were not paid attention to. And therefore, the client is being faced with the prospect of spending a lot of money on cure, or when it could have spent a little money on prevention. So a contract, there I'm referring to a contract your client has with another contracting party that may have insurance requirements. Read and understand the contract and follow its requirements. Next. We talked about crafting good insurance requirements for your contract, so you can move on to the next one. Read the policy and discuss it with your insurance professionals. It's interesting how we as lawyers would never, ever counsel a client to sign a contract with another party that they haven't read. It would be obvious malpractice, and we'd never do it. But we rarely, though, do I see even lawyers recommend to their client that they read their insurance policies or actually read it for them. So insurance policies are contracts also, and the same rules apply. So read the policy. Next. Can't emphasize that one enough, but we've talked about it. Move on. This is a big one because people assume that your good neighbor is going to be there, you're in good hands, all of those things until you encounter one of them in regards to a claim. And that's when you'll find out that they're not your friend. They're not your client's friend. They're an adversary. They're trying to save money any way they can. I will caution you that my perception of that arises from the fact that I'm always involved when things have gone wrong. I'm not involved when things go right because no one contacts me. So it may not be a universal rule, but certainly in the world of coverage matters and disputes, uh, don't assume the insurance company is your friend, and you shouldn't from the outset. It's really about that whole notion of understanding your policy, knowing what you're buying, knowing what it says, buying better if you can, and planning around things if you can't do better, and not having unreasonable expectations or having your client think that you're somehow responsible for making sure their policy provides the coverage that they want. Next one. That was just a graphic to prove the point. And so this is the notion that very often even when people have an insurance claim, they want to handle it themselves or without the required expertise until they see whether it's really going to be a problem. And unfortunately, by the time they see that it's really going to be a problem, they could have dug their hole deeper on their insurance issue. And I'll go back to that example of the woman whose ring was stolen and talking with the insurance adjuster on the phone and saying she wore it every day. Now, she can't get around the facts and can't lie. Obviously, that would be insurance fraud. But just as we deal with clients in depositions all the time, we don't necessarily have to offer information. And we can plan ahead if we've read the policy. So at the right time, contact an insurance professional. And I say that with the warning that, we have brokers, we have public adjusters, and we have coverage counsel. I see in the world too often the mistaken notion by clients that a broker is capable of being a lawyer, and that's not the case. And I would even say that great non-coverage lawyers are not necessarily qualified to function as coverage lawyers. So you can close the presentation. I think that's about it for that presentation. We have 8 minutes for questions. You don't have to show that. Everybody can read that later if they want to. But why don't we see if there's anything that anyone wants to bring up and discuss? And if not, I can make a few other points having to do with traps, pitfalls, and swindles for lawyers in their professional liability policies. We have a whole other presentation on that. But if there are any specific property-related matters that I can address now, let me know.
David, I have a question on renters, homeowners policies and whether you have the additional insured endorsement versus an additional interested party. If there's suits between the landlord and the tenant, but considering the limitations of what's covered under renters policies, does it really matter? Is it better for a landlord to be just an additional interested party versus an additional insured, or is it a difference without a distinction?
I think in this instance, it might be a difference without a distinction. And again, what you want to make sure in both instances is whether there is an insured versus insured exclusion. It took a moment for that to come to me. Insured versus insured exclusion. So if that means that, let's say a husband and a wife own a car, there's an insured versus insured exclusion. They're both covered under the policy. One cannot sue the other one and get coverage under the policy. By the same token, if you have an additional insured and the insured itself, and there's an insured versus insured exclusion, you'd be preventing a lawsuit from one against the other. So you want to make sure you know when you have an insured versus insured exclusion and whether it makes sense for you under the circumstances. The property management company for a rental property is very often included by category in the policy. So I don't think I've ever seen a rental property policy that did not include the property manager by category. They say anyone who's your property manager. Now, I mentioned that case where there was the dispute about whether the single purpose entity was insured, and in that matter, the property manager had a contract with a single purpose entity and not with the named insured. And so the insurance company is taking the position that the property management company is not insured, but that's because of that difficulty with that case and not just based on the category that they're a property insurer. There's no harm with having your property insured named in the policy by its own name. However, if mid-policy or 6 years later and no one's thought about it since then, you get a new property manager, you want to make sure you actually have the property manager covered by category. And I'd recommend a contract with your property manager specifying when and when not, who is going to indemnify whom, and what's excluded from the owner's duty to indemnify the property manager and vice versa. So because those often are disputed points when it comes to say in a habitability case, whose fault was it? Was it the property manager or somebody in the seniority of the property manager or the owner? iPhone Zipporah, I didn't quite follow that question. Could you ask me again?
I think she added as owners.
I
to the-
didn't follow it because I didn't read it while I was talking. So if you can just read it for me again.
Let me see. Let me find it.
Something about a husband and a wife.
Husband and wife, should they be added individually to the property as property owners?
If they are, I mean, if they're anybody who actually owns the property should be identified on the policy.
Right, I think you answered. Thank you.
All right. So if anyone has any more questions, I can answer. If not, in the last 3 minutes, I'll give you some things to watch for in your professional liability policy. One thing to look out for is whether there is an exclusion for legal malpractice claims asserted as counterclaims in collections actions. Because very often lawyers won't know that, oh, I'm going to go after this client for fees. Naturally, the client countersues for malpractice. And there are policies that will exclude the malpractice claim if it's in response to a collections action. So you want to know that before you file your collections action. You may decide you don't want to file it, or you may decide you're going to wait until you're sure that the statute of limitations has expired on the malpractice claim. It's a 1-year statute. The termination of the representation should have been in writing, and there should be no issue of a potential continuing treatment. And then you should wait beyond the year and then file your collections action. The claim for malpractice will not go away as a set-off, but it will go away as an affirmative claim. So if you sue the client for $1 million for fees after the 1 year and they countersue for $5 million, you can say, well, no, you're stuck at $1 million as a set-off, and you're not going to get that $5 million even if you prove your case. So you probably want to do that whether or not you have that nasty exclusion in your policy, but you want to wait out that year after you've very clearly drawn the line that the representation is over and there's absolutely no argument that the treatment was continuing. Another thing to be aware of is the hammer clause. Very often in professional liability policies, whether they're medical, accounting, or legal, or what have you, they will say that the policyholder has the right to approve or disapprove settlements. And the reason for that, it developed in the medical area because doctors would have to report the claim and it might harm their reputation as a doctor. And so the policies were starting to be written that said, well, we won't settle unless you consent. So the doctor thinks, well, that's a good idea. But there are things that the insurance company slips into the policy that are potentially harmful, and it's called a hammer clause. And a hammer clause will say, well, if you disapprove a settlement, suppose we could settle it for $50,000 and you disapprove it. Well, one hammer clause consequence could be, depending on the terms of the policy, we're not going to be responsible for anything over $50,000. So if it's a $500,000 verdict, you're stuck with the 450 and the insurance company will pay the 50. Another thing that hammer clauses will do is reduce the amount of defense costs they'll pay. Say, well, from now on, we're only paying 80% of defense costs. So beware of what your policy says about a hammer clause. I saw there was a question. I also see that it's 1 o'clock.
Do we time for one question? I believe it's regarding what types of cyber coverage or what clauses are in the 50% that affords coverage for the hypo that you noted. Regarding the
Well,
secretary instructs the transfer.
It's highly dependent on the language of the policy. There's not a one size fits all answer to that question. As in most policies, you have to look at everything. But in cyber in particular, it's going to be very, very depending on what the risks are. But thank you all for your attention. I apologize once again for the technical difficulties that I've had today. But I had a good time speaking with you all and look forward to seeing you all the next time.
Thank you so much, David. Really important information. Everyone, your MCLE will be going out later this afternoon. So thank you all. Have a good, safe weekend.
Thank you all. Take care.
Thank you.